Yo, what's going on, people? Ray Woods here, channel Real Estate with Ray. In today's video, I want to get into the 5 reasons why you should not buy a house. Now, a lot of people already didn't backlash me about this video, but I'm about to get into the details as to, why you shouldn't really buy a house. And these details are strictly by the numbers. This is not just my opinion. This is something that is strictly mathematical in what's going on and why you shouldn't do this. So the first thing I want to use is the financial strain of even getting a house. And within that financial strain, you're dealing with the upfront costs, you're dealing with home and market equity, and then you're dealing with maintaining the house throughout your time of being there. So the financial strain. For this example, I'm going to use a $300,000 home. And this is assuming that you're using a FHA loan and you're a first-time home buyer. You're going to buy a house, you find a decent price, you can basically afford that $300,000 home. Let's get started into that property. You put 3% down on that property, and at a 720 credit score, which is damn good, you're looking at a 6.6% interest rate, and that's around the mid-February time as of the recording of this video. And you're looking at 30 years for the mortgage. Let's look at the upfront costs. Upfront costs, if you're talking about agent fees, if you use the agent, if you're talking about any closing costs that's associated with it, any other fees this has to do with the closing attorney, you're looking at about $33,000 or so to have for upfront costs, as well as the down payment to get the loan in the first place. Now let's look at the home equity for the property. Now for your home equity, I like to use 2 different types of equity. You have the equity for the market and you have equity for your house. The house equity is when you're paying basically into your mortgage, and the equity difference between what's owed and what you've basically paying into the property. So if you have $100,000 and you pay $50 in, your equity in the home is $50,000. So let's just say after 5 years with the interest, after you pull out the equity, you're technically negative at that point. So you even more negative than the $300,000 that you started with, and you're around like 342 whenever I calculated the math. I won't get into the full calculation of the math and how I got to that number, but once you pull out that equity, you're gonna be paying interest on the amount that you pulled out for that property. And not to mention, you're not even gonna get the full amount of equity that you pull out. They're gonna give you up to a certain percentage of the equity you have in the home, assuming that you can pull it out at that 5-year mark. Then if we go into the market equity, let's just say your home value goes up $200,000. It will finally put you in the positive if you wanted to pull out equity, $14,000, around that number. But remember, I haven't even put interest rate into that. So after you put the interest rate of paying throughout those 5 years and your home went up $200,000 within that 5 years, you're still negative. So I don't understand how people say buying a house makes sense simply for the equity point, because when you buy into the loan, when you grab the loan, you're automatically owing the bank that money of whatever 3% minus the 300,000 is. You're owing the bank that money and you're negative. So on your financial statement, you are negative on your balance sheet. Now let's get into maintaining the home. When you're talking about any type of repairs that need to be done to the home, maybe you need to replace an HVAC, maybe you need to get some other appliances that messed up into the home, maybe you had a roof leak, anything can happen within the house that you're living in. And I looked up some statistics, and you're looking at about an average of $10,500 to $11,000 to maintain the house every single year after you didn't purchase and got into the home. And that's assuming that you're not going into a new property that's newly built, or you didn't newly build, and this is assuming a property that you're actually going into that needs some type of work. It's maintainable, you can move into it and it's fine, but you still may have to do some work here and there. Now on to the third thing, the fourth thing, lack of flexibility. Let's just say you ended up getting a great new job, and right now you're making $100,000 in your job, and this job says, hey, we're willing to pay you $160,000, but you gotta move. You gotta move closer. We like your stuff. You gotta move. What's the flexibility of you being able to move to that new job? Because if you need to move, or if you got a family emergency or you need to move, you either gonna be paying for that property that you have, or you're gonna have to sell it. And if you're gonna sell it, are you gonna sell it yourself? Are you gonna hire out an agent? What if people need to show the house? You're gonna have to pay some type of fee for somebody else to show the house so you can get it sold, and worried about if you're going to be able to sell the home on the market depending on what's going on. Then if you have to move, you got to pay for movers. Either you move it yourself or you paying for movers to move it yourself. Then on top of that, if you don't want to sell it and you want to rent it, who's going to manage the property? So there's so many different scenarios that you could do with the property when it comes to moving, but it being very flexible is not there. The flexibility of leaving the house and not being able to pay for 2 different things is going to be difficult. And yeah, you could probably go stay with a family member to take care of them. There's always some type of exception, but even if you're not in the house, you're still going to be paying for it. And what if something happens at the house and there's nobody there to watch the house? Maybe you have a random leak and you're not there, and you come back and your whole home is underwater. Now you got to pay for that mess. So the last and final reason why you shouldn't buy a house is because of the opportunity cost. Now, the American dream quote is always to save up money, buy a house, have a family, have kids, pay your house off. Now you're living debt free. That's the American dream, right? Well, is it really so much a dream? Or are they just painting a picture so you can get to a house so you can make the banks richer? Because people like to clown those who are renting and say you're making a landlord richer, but when you buy a house, you're just making a bank richer. So what's the difference? Now, the purpose of a house being your best investment, that's typically another thing people like to say, your house is going to be the best investment you ever made. Well, if you look at the numbers as we stated before, how is it a best investment whenever you're spending money? Because the investment is supposed to give you some type of return. The investment is supposed to give you some type of money back. And the only way that I see that happening is if the market goes in such a way where you benefit greatly from when you purchase the property, even after interest rates, even after all the repair money that you put into the property, and in hopes that the market continues to go positive, which at this very moment you see the market is going to shit. So it's always a dice roll when it comes to saying that this is your best investment, because it may not be. Yeah, the people back in the day, it may be a best investment for them because they bought properties at 5 cents and a bag of candy, and then they could buy a house. Now we don't really see that happening now. It's a lot of millennials that are not able to buy that property. What I personally think you should do, and what would make sense for the numbers, is when you get into a property and you actually cash flow the house. That's where your true opportunity cost is going to come in at, because now not only if you get into a triplex or a duplex or whatever, and I'll link a card up here in the video where I actually break down Fannie Mae's new program where they're allowing you to put a lot less down so you can get into this multifamily residential property. You can get into these and rent out to others so other people are paying for your mortgage. So yeah, it's negative on your balance sheet, but you're balancing it out because somebody else is paying for that particular mortgage on that property. Not to mention, if you got extra left over, you don't have to come out of your pocket. So that money stays with you. So buying a house for yourself to live in, to me, it only makes sense when you're able to cash flow any other parts of the house. Even if you have a townhome and you have a bottom portion, you can Airbnb it out or rent it to somebody, or rent a room where they're not specifically in your living area and make that house profit that way. That's how you would make that house a good investment. So to close out the video, let me know, would you rent or does it make more sense to buy? Let me know your personal opinion, if it's better for you to buy or rent, because everybody's situation is different. And you know, I'm just saying, man, the banks, they play this game all the time. And all I'm saying, I'm not fully opposed to buying a house, but at least try to become the bank whenever it comes to buying your house.